Statcan just released the inflation numbers for April, and inflation is continuing to trend downward, coming in at 2.7% year over year, raising expectations of a rate cut from the Bank of Canada. But the question everyone is asking is, when will the first rate cut be made? Well, if you want to know what I think, I'll just tell you right now. Probably June or July, and it doesn't really matter which one. Sorry, I know as a video creator I'm supposed to wait until later in the video to reveal that sort of thing, but I don't like that, so I'm not going to do it. That's right, folks, it's time for another Friday update with your old pal, Millennial Moron. I've got 3 stories for you this week, and it's all classic Friday update stuff. Inflation, the housing market, rent, nobody's happy. But if you are somehow enjoying these videos, please remember to like, subscribe, leave a comment, all that kind of stuff, because it actually does help me to keep making videos. First up, the headline inflation for April came in at 2.7%, down from 2.9% in March. More importantly, the Bank of Canada's preferred measures of core inflation all trended downward as well, raising market expectations of the first rate cut since the bank first started raising rates back in March of 2022. One of the big drivers of the drop in inflation was food prices, with grocery store inflation slowing to 1.4% from a high of 11.4% back in January of 2023. Keep in mind that what we're seeing here is disinflation, not deflation. So while prices obviously haven't been coming down, they're increasing much more slowly than they were the last couple of years, which should at least provide a little more predictability, but not actual price relief. Bond markets reacted with the 5-year bond yield dropping a bit on the news, with the BAX market increasing their expectations of a rate cut in June to roughly 50-50 odds. One of the factors this month that people have said could delay a rate cut was our unexpectedly strong job numbers in April, where it was reported that we added 90,000 jobs, although it was also reported that the size of the labor force increased by 107,000 people, so the unemployment rate stayed flat. However, I don't know how much weight the Bank of Canada will be putting on this, and I think we all need to take those numbers with a grain of salt as well. I didn't really get into this last week, but there's a chart that's been making the rounds on social media from National Bank Financial showing the growth in the working age population in the first 4 months of the year compared to previous years. And it looks pretty crazy, right? Over 400,000 people added in the first 4 months of the year, which is about quadruple the average in recent years. The thing is, the data from the first 4 months of this year isn't really real, it's more of a projection, and I'll explain what I mean. The data in that chart comes from Statcan's data tables on the labor force, which are updated monthly based on a program called the Labor Force Survey. However, this survey doesn't actually measure population, it just collects data from a survey of how many people are working, whether they're working full-time or part-time, hours worked, wages, that kind of thing. The numbers for the size of the labor force, and by extension the numbers for job creation, are estimates that are extrapolated from our quarterly demographic estimates. The quarterly demographic estimates, which give a better actual estimate of the population, are released once every 3 months, with the last update being at the end of March, which provided data up to January 1st of this year. So basically, in that chart, we're talking about population growth in the first 4 months of the year, but it's based on data that's 5 months out of date. The next update won't be released until late June or early July, which should give us better data on the first 3 months of the year. The thing is, most of the time when we have steady and predictable population growth, this system works perfectly fine. However, we're currently in the middle of a situation where things are changing rapidly, which adds a lot of confounding factors to trying to actually measure these kind of numbers. Over the past couple of years, our population growth has been accelerating rapidly and is almost entirely driven by international migration, but now the government is scrambling to try to get it under control. There have been changes in processes at the IRCC and changes to things like student visas that are probably having significant effects on the pace of immigration. So, as much as I like data and numbers, it's also important to be aware of how those numbers are measured and reported and what impact that has on their reliability. I think we're starting to get into a situation with a lot of flux happening in a lot of different areas, so these kind of stats are getting a lot murkier. Just because a number gets published on the Statcan website, it doesn't mean we can regard it as the gospel truth, so keep that in mind when you read headlines in the coming months. So back to interest rates, like I said in the intro, it's looking like there will probably be a small rate cut in June or July, and in my opinion, it doesn't really matter when. There's going to be a huge reaction in the news when it happens, and probably an even bigger reaction from realtors on social media who will try to convert it into a feeding frenzy in the housing market, but in my opinion, a quarter-point rate cut is really not that big of a deal. I think the overall story that's been told in all this data since the start of the year is that although we're getting within range of the first rate cut, the main thing that's indicated by all of the data is that rates will be staying higher for longer than we were expecting last year, and that's much more important. The thing is, what really matters isn't the exact peak interest rate or exactly when rate cuts start, it's the combined effect of increased rates and their duration, along with our overall debt burden. For the nerds who took calculus in high school or college, we're talking about the integral of the interest rate, which means the area under this curve. That's what corresponds to the actual total amount of money that's going to be pulled out of households due to interest payments. Whether a quarter-point cut comes in June or July doesn't really make much difference, but the fact that we're now expecting only a 1% rate cut by the end of next year, when a few months ago we were expecting the rate to be cut by 2%, is a much bigger story. A full percentage point higher over the course of a year is a much bigger effect than a quarter percentage point over a month. On the flip side, RBC is projecting that we'll still see 2 full percentage points in cuts by the end of next year, and we'll be going back to double-digit home price increases. So who knows, maybe everything is just going to stay nuts. Next, the Canadian Real Estate Association released the national housing market stats for April, and despite a lot of predictions of a hot spring market this year, sales declined 1.7% month over month for March. Sales activity did come in 10.1% above the historically weak year we had in 2023, but a decline from March to April is very unusual, as spring is usually the time when sales activity starts picking up, generally peaking around May. Something that was left out of the headline and the lead part of the report was that the home price index was unchanged month over month and declined 0.9% year over year. Of course, with inflation coming in at 2.7%, this represents an even larger decline in real value. This is something I talked about back in January and again in March, but since the rate hike started in 2022, prices have generally been in decline, but last year we had a temporary rebound in prices which peaked in August before declining again. The previous minimum price was reached in March of 2023, which means that we're now in a situation where the 12-month trailing price of homes in Canada is rising. For the calculus nerds again, we're talking about the year-over-year change in the first derivative of the home price index. In 2023, when prices were going up and the 12-month trailing price was falling, the year-over-year price numbers looked decent, so the headlines focused on that. Now that the 12-month trailing price is rising, we're going to see year-over-year price declines even if prices stay flat month over month, so naturally the headlines are focusing on something else like sales and putting the price data farther down in the press release. Based on data from the CREA and Statcan, after adjusting for inflation, prices have dropped 21.4% from the peak in 2022, which puts us on par with the real price decline we saw in the housing crash of the 1990s. The main difference is that price decline took almost a decade from the peak to the bottom, and our current price decline has only been happening for a little over 2 years. Basically, like I've been saying in all sorts of videos for the past year, I'm not predicting a housing crash, I'm just describing it to you as it happens. Prices are down, sales are down, listings are up, and people everywhere are drowning in debt. I don't care if you want to call it a crash or not, but whatever it is, it's definitely happening now. Finally, Rentals.ca released their monthly rental market update for April, and as usual, it's all bad news. They post a pretty good summary of rent price data across Canada every month, and I was actually on their podcast a few months ago. This channel isn't sponsored by Rentals.ca, and this is not a product placement, but if the Rentals.ca team is watching, please send me as much free money as possible. Anyway, rents across Canada were up 9.3% year over year. As usual, Toronto and Vancouver were among the most expensive cities to rent in, but rents there actually declined slightly year over year, possibly due to the number of new build condos currently held by investors who don't know what to do with them. Meanwhile, rent increases provincially were led by Saskatchewan and Alberta, with increases of 18.4% and 16.4% respectively. In a bizarre Captain Planet with your powers combined type of situation, the highest rent increase in the country was seen in Lloydminster, which straddles the border between those two provinces. It's in Alberta. It's in Saskatchewan. It's in the combination Alberta and Saskatchewan. What? Lloydminster had a staggering year-over-year rent increase of 26.7%. And keep in mind that Lloydminster isn't exactly a big city. It has a population of about 30,000. If anyone in Lloydminster is watching this video, do you have any insight into what's going on there? Are you guys okay? Let us know. Anyway, long story short, rents are at record highs, vacancy rates are at historic lows, and according to CMHC's Housing Market Outlook, rental demand is projected to continue to outpace supply, so things should be getting even worse. That's all for this week, so as always, thanks for watching and enjoy your weekend. As a heads up, I'm going to be traveling for work for the next couple of weeks, so I'm probably going to be focusing on research and writing instead of trying to crank out more Friday updates while I'm on the road. I might put out 1 or 2 new castle videos, but to be honest, it's a lot of effort to try to produce these analytical videos out of a hotel room while I'm working long hours, so instead, I'm going to try to use it as an opportunity to do background work for some other content. So, thanks for watching, remember to like and subscribe, of course thank you to everyone who's supporting me on Patreon, and I'll see you in a few weeks.